I have never seen this room as packed as it is right now. So this is going to be one heck of a tech week. Welcome, everybody. All right. So before we get going here, just by way of introduction, my name is Denis Nagasaki. I lead the East Coast startup banking team for Silicon Valley Bank, a division of First Citizens Bank, based in Boston, but spend a lot of time here in New York. And our team works exclusively with pre-Series A founders. We're a purpose-built bank for the innovation economy, working from inception through IPO and beyond. And so, whether it's debt conversations, broad banking, or just connectivity into the market, we're super excited to work with you and host events like these to bring, thought leaders, that can really benefit each of you as you're building. Nick, we'll start with you and just a bit of a brief intro on who you are, what you're up to, and then we'll continue on down the line.
Sure. So I'm Nick Adams. I'm one of the co-founders of Differential Ventures, based here in New York. Started the fund almost 9 years ago, investing of our third fund now. Everything we do is in the enterprise AI data infrastructure space, which is where my co-founder and I spent our entire careers. Sweet spot's usually leading seed rounds and going into Series A for follow-on. Invest basically 100% here in North America. Done a couple deals historically in Israel, but mostly US based.
Great.
Hey everyone, I'm Karl Eshwer. I'm with BDev Ventures. We started in 2021 and are now invested in about 80 portfolio companies across the US, Latin America, and Europe. Traditionally enterprise software, seed and Series A co-investor. I lead all of our diligence function here at BDev and been with the team about 4 years.
Hi. Ooh. How many lawyers does it take to turn on the mic? Hi, I'm Lindsey Mignano. Nice to see everyone here. I'm the founder of Mignano Law Group. Our firm represents startups seed through Series B, heavily enterprise AI right now. I am a law firm founder. Previous to MLG, I founded SSM in 2016 after breaking off from Big Law. So I've basically been kind of on my own now for about a decade. I'm really happy to have my team. We're a completely virtual law firm. So our staff is in the SF Bay area, and one in New York, one in Toronto, and some in Texas.
Thank you. Hi, Anish here. I'm with Swisscom Ventures. I'm a venture partner. Most of the team is in Switzerland. We're a large telecom in Switzerland and a strong number second in Italy. About 700 million in assets under management, a venture firm that's been around since 2007. We kind of have a hybrid approach. So 75% of the LPs are institutional LPs and 25% is anchored by Swisscom. So we're very much financially driven. Our focus areas tend to be enterprise software, horizontal solutions like cybersecurity, developer tools, DevOps, IT infrastructure, AI, of course, and so on. Typically Series A, B, and C is our sweet spot, checks of 5 to 10 million, and then we reserve more for follow-on rounds.
Awesome. Thank you. Well, welcome again, and thank you so much for being here. Let's jump right in. So off the top, this is all about how to raise a Series A. We're going to speak, high level. We'll get into some tactics, and we'll leave some room also for the audience to ask some questions. But just starting out of the gate, if a founder were to walk into your office or one of your offices today and say, "Hey, I think I'm ready to raise my Series A," what are the first things that you guys are thinking about stress testing? And what are some tells that may indicate that they are, in fact, not ready to raise their Series A yet?
I think, first of all, I find founders tend to index on like, what's the revenue number I need to be at? Everybody told me I need to be at 2 million ARR, and now it's 3 million, and that's 4 million. And, whenever that question comes up, unfortunately, the very unsatisfying answer is like, it depends. I mean, at the application layer these days, traction levels are higher than ever before because early revenue in today's age of AI can be extraordinarily misleading, which, at seed, even 5-6 years ago, $500,000 to $1 million of revenue could be very valuable or very misleading. Now those numbers can tick up into 10 million, 15 million. And you still might not know if you're really defensible and able to continue to scale. So that's kind of the first part of like, what part of the tech stack and the level of defensibility do you have is really the first thing, and less anchoring on what's my ARR number. The other thing that, and and I'll end here. But I think a lot of what gets neglected a lot from like the ARR conversation and readiness for AI is not just the ARR number, but the growth rate behind it. You know, venture capital is very much a momentum business. So even if you kind of claw your way to $3, $4, $5 million in ARR, if you're not doing it at a pace that's fast enough that excites a Series A investor, you still might not get that round. So I think that's another important consideration amongst lots of other things around defensibility and team and repeatability of your motion.
Yeah, I think the repeatability in motion is so critical for whenever I have these conversations with founders. Is if you've gotten to this 3, 4, 5 million in ARR number, but it's all founder-led sales, then the immediate sort of heuristic in my mind is how does this scale, right? Is there a sales motion, sales team behind it? And so that's been a checkbox that has been hard to sort of check recently, especially with AI being so fast-paced and founders being able to sell and get revenue numbers on the books quickly. But the piece that seems to have gone missing is there a sales team that can now take this from 5 to 15 million in ARR? And so that's been a check that I've been looking for recently, and having an answer there and a repeatable motion, and even better if there's a team in place or plan to make this team happen, I think is critical.
So we've got hundreds of clients right now, and I tried to think about what like are the top 5 qualities when I see seed companies stall versus actually raise pretty quickly. And anecdotally, on our docket, maybe 1 quarter will actually go from seed to Series A. Obviously, if they're venture funded at the seed level, that really, really does help. As a pre-seed or seed level, that really, really does help. And these are the top 5 qualities. And some of it was already said, which is not just about ARR, but the quality of the growth and the speed of the growth. Some of the clients that we have that are raising from seed to Series A and closing their next round in like less than a year are growing so quickly, both in terms of customer acquisition, but also like headcount and staff. And they're growing very intentionally such that, and I think there's more important attention to this, but their employees are really efficient. Like if you look at the number, like dollar per employee that they're actually outputting, it's a smaller team, but they're using tools to make them really, really efficient. Even the cost of economics, like in terms of like their customer acquisition becomes lower, right? Their unit economics. So they're doing really, really well on that. They also have really good NRR, which means like they are usually like deploying to one department in a company and then possibly even getting into other departments or expanding the use within that department. So you're seeing really good customer feedback and stickiness there.
Cool. Yeah, I think just to add to the fellow panelists, I think for me, some of the things that we look at in addition to what was said is efficiency of how things are managed at Series A. So when we're looking at Series A, we're now looking at companies that have traction. It feels like what it used to be Series B 5 years ago. So if you kind of backtrack pre-seed, seed, Series A, now you've been around for a few years. And with AI, the growth rates are pretty incredible. Same with cybersecurity and some of the areas that we're seeing that are hot. So some examples of metrics that we look at on the efficiency side, 0.5x burn rate. So if you're going to invest a certain amount or raise a certain amount, how much net new revenue are you going to add? To every dollar that you bring in, you're going to be growing $2 in terms of revenue. GRR, gross revenue retention, 90%. NRR 120%. So there's a lot of variation depending on what sector, what industry you're in, where you are on the stack, as was mentioned earlier. But just as a reference point, just the bar has gotten a lot higher. And so when you're looking at companies that have revenues of $3 to $6 million, we're looking at what type of business models they're using now. We have historically invested in a lot of SaaS companies. Some of you have probably obviously heard that what's happening in terms of reset, in terms of valuations and multiples there. So I think for us, a lot of the diligence questions today are around how are these companies evolving and adapting to the future.
Awesome. Awesome. Thank you. Let's keep going. So tell me maybe a little bit about a deal that derailed, and not because necessarily it was a bad company, but because of the process that the founder was running, maybe wasn't as tight, or wasn't what you would expect to see. Obviously, it's a very fast-paced environment that we're in right now. Let's maybe think, tactically, an example of where you've seen something derail and maybe what were some of the drivers around that on a Series A raise.
So many. Maybe a couple examples. Sometimes we're really excited about a company. They've done really good on the pitch. A lot of the storyline resonates with us. When we get into the data room, a lot of different things start emerging, right? So sometimes there might be some legal issues between prior founder that has left and it's still lurking, it's not fully solved. Sometimes it's not a clean cap table. Sometimes we find through our own diligence, people that know the founders from the past and raise some red flags for us. And I think the other one is around customer concentration. That for us, I think every venture firm might look at it a little bit differently. But if we think, oh, okay, these guys have 30 customers now, it's looking really good, but it turns out that 2 of them represent 60% of the revenues. To us, in the past, because we've been doing this since 2007, a lot of times we've seen those companies not be able to break that chasm. And then from a competitive landscape perspective, it becomes something that becomes an issue later on. So if you can cross that where you're not concentrated in a very small set of customers, that's important to us.
Yeah, I've tended to see a lot of convertible notes run away from founders. So they raise a bunch of safes and convertible notes and not really have a good sense of what that means for dilution for their equity. And that tends to become an issue when you do have a lead that's locked in. If that math isn't sort of top of mind, then when you do, have Lindsey drop your docs, you're going to see that, instead of thinking you own 40% of the company, it's probably 18%. And that's happened all too many times, more times than I can count, which then derails the round because there's almost a renegotiation that needs to happen with your lead investor, with everyone in the past for a founder top up. And that's sort of been the most common scenario I've run into.
And I'll double click on that for sure. It's too much money on safes before your priced round, and it's too low of a valuation cap is also what we see. A lot of people incorporate online these days, and there's no shame in that game. I think they've got really good options out there. I think what we see is when they usually come to us, they're coming for a round. They might have issued either too much on safes, too many safes, or they might have clicked a button that said add MFN. And that actually is kind of an interesting way to screw yourself and not really know, because if you gave an early investor in your 2 million safe round a really, really, really low post money valuation cap because he was your first money, and then you just automatically somehow give everyone MFNs and you end up raising more than 2 million, then we have a problem, right? And we don't normally discover that until we look through your cap table software and we actually model out the raise. Shout out to Cake right there, because you can model out the raise on your cap table software, and you should. It usually comes up when your CFO, shout out to Pilot, goes through your cap table, does your pro forma, and realizes, oh, all these side letters are attached. And guess what? They all have this MFN provision. The other one is you gave up too many pro ratas because you really liked everybody. But then you're hot at Series A, and now you have to take in more money than you actually need because you have to either walk back on those pro ratas or you have to honor them. And so that is when we see our clients not necessarily derail a raise, but it takes longer to close that.
I think, especially in today's world of rapid growth and media attention around huge AI rounds, is the compulsion to overstate your progress. And I think worse than ever, we're seeing just this blending and bastardizing of the term ARR for revenue that might be ARR, but it also might be just MRR. It could be committed ARR, but it might not be. It may not be committed ARR, but it could be sort of, likely to convert to committed ARR. It could be proof of concept revenue. And I just seeing too many founders overstating what they are today, and then also getting a little too excited and overstating what they think they can be in a year. And because yes, we are seeing companies grow faster than ever, but if you're a founder going out for your Series A, it doesn't benefit you to and this is a very real life story. It does not benefit you to say that we're going from 9 million this year to 110 million next year. It's a real example I saw. I don't know how to underwrite that. Nobody knows how to underwrite that. Like, show me your, 3 to 5x growth would be amazing in the next year. And then if you would overachieve that, fantastic. Nobody's going to complain. Like, you can't model that and tell that story in your fundraising pitch. If you can, you're probably not in this room right now.
Awesome. Did it again. Thank you. We touched on control provisions in the last round. I think, Lindsey, you mentioned it, but are there other kind of, watch outs that early stage founders need to be considering at the pre-seed, at the seed round that, may not feel important at the time, but is something that can come back and bite them later on, particularly around the A? I know you mentioned a couple items. Are there any other areas you guys would like to dive into?
IP ownership, which sounds so like, of course, but not having every person who touches your company sign a CIIA or PIIA. It is so common to get that form out. Normally, the online incorporation services provide you that form. If you work with a PEO like TriNet, usually part of their onboarding process requires that you sign something like that. So having your employees sign the proper legal documents is super key. Our biggest issue is founder fallout at the early stage. So 1/3 of our, well, that sounds high, but it actually is true. 1/3 of our startups on our docket will have a business divorce. And that is incredibly common. It's really hard at the early stage. And one of the big fights that happens is, was that his IP or did he assign it to the company? Especially when there's no signed legal documents. There's no offer letter, there's no CIIA, there's just a RSPA with a unsigned IP assignment. So that is one of the things that can really derail, because co-founder divorces can be super expensive, but if your co-founder didn't really assign his IP to the company, that can be really problematic funding.
Yeah, I think coming back to another perspective, if you're sitting in the founder's shoes and you're at pre-seed round, as you think about the next couple of rounds, I think one of the things to put yourself in is 2 steps ahead, thinking about the seed round and Series A, and just imagining you're in the Series A in a few years, 2-3 years. What should that look like? And getting advice from some of the investors or entrepreneurs and other folks that are in that stage and the stage ahead of you. And I think having that outlook for multi-year, because a lot of times, especially for first-time founders, there's a lot of excitement. If you do have a really good idea and you're able to raise some money, you might get super excited, not thinking about the next steps. And when you get to that point, you raise the money and you don't necessarily hit the milestones that you hope to hit for seed round. And it becomes harder for you to raise that round. You end up in situations where you're doing multiple rounds or struggling. So I think, as Lindsey had said, about 20% of companies that raise a seed round end up raising a Series A. That means 80% are not able to. So thinking about the steps ahead is super important. I think we spend a lot of time valuing the team, and some of these things that Lindsey mentioned around divorces. I mean, that's a big reason why businesses can fail early on. So a lot of times we'll see as a red flag in pre-seed stage companies, people are trying to start a company and they meet some other person and they have a good connection and then they start a company, but they have never worked together. They don't have a history. And when that roller coaster comes up and the times are hard, they don't know how to navigate that. Whereas if you've worked with this person and you've known them, that helps eliminate some of the variables that you can't foresee. So I would say that that's super important to think about the team composition. And the other piece, the last thing I'll mention is when you're raising a round, you don't think about this as a time-bound process where you're going to start and finish at a certain time, and then you've got a break for the next year. That's not how it works. For a CEO, you're always raising. That doesn't mean that you're actively opening a round, but you're always talking to investors, getting a pulse, talking to your advisors, trying to understand where the market is going and how your company is hitting the milestones to stay in tune with how the market is shifting.
I think one thing that's been interesting working with founders who work cross-border, so U.S. companies selling in Latin America, is in many jurisdictions you need sort of a local entity like Peru or Chile to do business there. And so you reach your Series A, you have all these disparate legal entities that have revenue coming in and costs going out that aren't actually connected to the company that investors are investing in. And so you get to the point of signing a term sheet, of course, is going to come out in legal diligence. And now, depending on what jurisdiction this is, you might owe taxes. It might take 30 to 60 days to actually connect the org chart. And a lot can change in this world in 30 to 60 days, right? Claude comes out with a new feature, and everyone's now questioning the relevance going forward. So that's just something I like keeping in mind, or top of mind, when you do start scaling into other geographies, is just having a sense of how this connects back to your holding company in Delaware or wherever else that might be.
Only thing I'll add is board and board observer construction. A dysfunctional board can really derail your company. And if you, as a CEO are not really adept at managing your investor base and a board, and or you don't have a lead investor around the table who's good at wrangling other VCs and can understand what their motivations, sources of stress might be when they come to the room, you'll spend a lot of time, you will waste a lot of time answering questions and sorting things out that just don't matter. So I think getting to a point where you have a productive board around a table, and I've seen them be amazing and help accelerate companies in serious ways, but a bad one can really derail you. And knowing when you have to go have conversations with your seed investor or pre-seed investor of like, hey, still love you, still give you the information and updates, but we need to scale back everybody that's in the room on board meeting day, is an important thing to keep in mind and track as you're going Series A and beyond.
Awesome. Thank you. I do have a few more questions, but I'm going to pause on the questions and go to the audience, because I want to make sure that the conversation that we're having up here is hitting the mark for where you are in each of your journeys. So any questions so far through the discussion from folks in the room?
I want to tell you what Nick just talked about, which is a typical Series A board structure and how much there is leverage on that from negotiation on both sides, and how you guys have seen that play out.
Series A, I usually say 5. 2 company, 2 investor, 1 independent. I think it's with the right group of people, it's super productive and makes sense. I've seen 3 go into Series A, but it's a little soft.
Yes.
How do you guys see initial debt all with the organization? Let's say we could of raise, and then approximately $1 million of debt. After that, they're raising a Series A of $10 million. How do you guys see that? Is it kind of a red flag for you?
Non-convertible debt or debt?
So the question was, how do you think about debt ahead of your Series A? So if you have raised $3 to $4 million in equity and you've also taken $1 million loan, from an investor standpoint, how do you think about that going into the A?
What SVB does, what the other does. How do you perceive that?
Usually you will restructure your venture debt at Series A. SVB is very good and productive in these conversations. There are other types of non-dilutive funding out there that are not as familiar with the venture asset class, that are a little bit more rigid, which can be harder. But if you're talking about $1 million on the Series A sitting senior to the pref stack, that's not terrible. If you've got, $5, $6, $7 million of non-convertible debt sitting senior to the cap stack, then you've probably got a problem. Gets a lot harder then.
I'll go here, then we'll go to the back, and then we'll come over here. But
Great discussion. Curious to know what do you guys think is a move today in the age of AI? I used to do AI business for Microsoft before, and they owned it. A lot of times, the past patterns you have seen may not work in today's times, right? So curious to hear a perspective on what you think is the most at this point.
just to repeat the question for everyone to hear, what in the age of AI, what does a moat look like today?
I think that's a really great question and a hard one to answer because I think there's so much stuff that's shifting. But I'll give you an example of open evidence. I'm a big fan of the company and how they've approached things. But for those that don't know, open evidence is a healthcare based solution, AI based. And one of the things that they did is that they license exclusive information from the New England Journal of Medicine. They did a partnership with Mayo Clinic. So more than 40% of physicians use it, and the acceleration which that adoption happened is incredible. But I was just speaking to a doctor last night, and they were saying how they use it all the time because the data that they get is absolutely valuable and helpful. And ChatGPT and Anthropic and Gemini cannot reproduce that today because they have that moat. So there's a period of time during which they have this data. For that period of time, they have this advantage, and then they'll find others. But that's one example. I think the other one, it's around stickiness with workflows. So given that we're looking at enterprise software from our fund perspective, companies that have integrated with other systems and where it becomes really hard for someone to take you out of the system. So another competitor would have to come in with a solution that's 10x better. Just 2x better is going to be too costly for them to switch. That's another one.
Yeah, I think doubling down on workflow entrenchment is just so critical now with data being used to be a moat 5 years ago, and now being entrenched in a workflow means 100 times more than that.
Look at it a few ways. Data arbitrage, distribution arbitrage. And then I think there's especially at the seed stage, there's a team arbitrage where, right now, OpenAI, Anthropic, they've spun out, they've partnered with consulting firms and PE shops to create, these massive consulting organizations to help, find use cases for AI within organizations. And they'll throw, 3 to 5 kids out of JP Morgan who can write a bunch of code and hack their way into use cases next to a CFO or whoever trying to, build traction and find ways to use tokens. I think, the seed arbitrage to that is if you are an expert or you have an expert in your area of domain that you're going after, and you can put a top level person next to the CFO and next to OpenAI is still going to have their 5 kids out of JP Morgan there, then you've got a chance at winning, I think, because now you're bringing this, more credible senior expertise to sure, here's things you can solve for now, but here's all the things that you're going to hit in the future that these kids don't know about, and I do because I've lived this pain. So I think those are the areas where I tend to look for that one more at the seed stage than Series A.
Awesome. Thank you. There was a question, right in the back.
Have a tier 1 from our institutional best practice.
No.
I almost prefer it.
Yes, right here.
Connected to the previous question, in the age of AI, has that somehow reshaped the way companies are coming to VCs in terms of what lower ticket, because perhaps now we don't make much money for product or than Weaver, or what are they looking for value to their proof to see that they see so?
Just to make sure everyone heard. So I think what you were saying is in the age of AI, are you seeing companies kind of need to raise less money? They're able to go further. Right.
I have clients who are, yes, they don't need as much because of the technologies that they're using. I think one thing that I'm hearing more of, and it's not just recent, although it is very relevant, is being more careful at the seed as to who you're choosing for your seed VC. There are tons of very large, agnostic in terms of vertical and stage VCs that you can choose, and they all have seed funds. They also have late stage growth funds as well. I think my clients who are being really, really careful about this are going with smaller shops with specialists that maybe they just invest in this one thing or this one vertical. And the reason why is because of introductions, help with partnerships, but also optics. And this isn't something that's really said very often, but if your seed VC does not follow on at Series A, there's no optics problem, right? If they decide not to lead your next round. We have had clients conversely choose like one of those like very, very large, take it up all the way to the chain, and then there's no investment or no lead at Series A or the next round, maybe even Series B. And it is a huge signaling aspect to all the other VCs on the docket, as well as new money. So I think the really smart founders today, in addition to determining like how much should I really raise, but they're being very, very smart about who they're putting on the docket for pre-seed and seed.
Yeah, and I think one of the things that I'm seeing, I think in the super, super early stage where they're just starting the first 3 to 6 months, I think one of the things that we're seeing is that what they're able to showcase from an MVP. Yeah, sorry. One of the things that we're seeing with super early stage companies when they just first start is the amount of traction that they can get in the first 3 to 6 months is far greater than what they could before. When you get to Series A or seed rounds, I'm not necessarily seeing rounds being smaller. We're looking at efficiency, like I mentioned before. So I think with the money that you get, what can you do? You can do a lot more. So the expectations are equally higher.
I would just say outside the super cost intensive startups, so if you're building new foundation models or in the GPU space or whatever, I would say most experienced repeat founders at their pre-seed and seed are actually opting for smaller, more focused funds and taking more reasonable valuations because they know the pressure of having a lot of the dynamics that have been talked about already. Massive valuation that you can't really grow into when the hype inevitably subsides in this space. The junior partner or principal at a large fund who takes a new job and now you're kind of an orphan at a bigger fund and nobody really cares about you because they wrote a $5 million check. And they don't really give a shit until they can write a $50 million check. So interestingly enough, seeing a lot more repeat, really good founders who have had good exits before take more focused, smaller fund money when they're first coming out of the gate and then pushing off that larger round, larger fund until Series A or beyond, because they know what comes with it, and the pros and cons are pretty dramatic working with a bigger fund.
Great, thank you. Yes, in the back.
Is there any downside risk to like IRA, like Naga investors versus and
Depends on the party, man. I mean, as a founder, your number one job is to fund your business and don't run out of money. If you can go raise $10 million from Andreessen day one, yeah, you should probably think about that. If you can raise, $2 million on Republic with, 250 angel investors, and that's, after 200 VC conversations, angel investors, family offices, that's what you can do. Go do it.
Yeah, I've been a part of a lot of these party rounds. I like the way you described it, but it just connects back to our value add because we spend so much time with our founders getting a deep understanding of if we can actually impact their outcome, that we're able to underwrite a completely different story to just pure metrics or narrative, just because we've worked together with them over an extended period of time where it makes sense for us to be a check in this more off-cycle dynamic where maybe it isn't sort of a set anchored price or anything like that, but it makes sense strategically if we're able to add an inordinate amount of value by virtue of being a part of this cap table.
On the topic of efficiency, like as a co-miner, like right now we're C, and so I'm a co-founder, but I literally am like, we need someone to fill a CEO role, like for efficiency. Like, do you see more success with companies that do fill that like first as you grow, raise like Series A?
So, and I'm a believer in the rise of solo founders in the age of AI. So I have a number of solo founders, and I would love to hear the VC's input on this. They are told sometimes when they go to seed VCs to get a co-founder. And it could be like the opposite of what I hear it more so the opposite of you. It's a female founder who needs a CTO or a CTO who needs a business guy, something like that. And they normally do get it earlier, and that does affect how much you give away. So some of our founders, like right at the start with no fundraising, we're seeing like a 55-45 split. I will say that my female founders get negotiated much more heavily than my male founders by that second person. Statistically on our dockets, we see that if we have a female founder who is the business person and she's taking on a usually male CTO, the ask will be for 51 and her title, which I thought is always really interesting to me because the dynamics are insane. But when the company's a little bit further along, and let's say that some money has already been raised and the product is pretty built out, then it's not a 55-45. And we even had a client who offered his second co-founder like 10. So I think it just depends on where you are in the cycle. But I do think we see most people get co-founders before a price round.
Yeah, and I think Lindsey brought up a few good points, and I think the market's been shifting. So for us, I think we really looked for co-founders in the past, and that's been shifting the last couple of years. We're open to solo founders, and we do invest in solo founders. I think the most important thing is team composition. And what I mean by that is if you bring in a CEO, obviously then at this stage, they would end up being a co-founder, but the composition of complementary skill sets is super critical and what's going to take this company to the next level. So the combination of that. And so that's the executive layer that you have in your firm, but it's also your advisors and your board composition as you're thinking about that strategically.
Yeah, it comes down to incentives as well, right? How you can incentivize this person to be a part of the team best while also protecting your interests and all the work that you've already put into this company. So there's a risk-adjusted return there that you need to definitely factor in.
Awesome. I think you had a question there before.
So you guys have mentioned that ARR is kind of a moving target in this new environment. In the same way, what do you look for from that front rate? Everyone's mentioned like the delivery of the run there at premium. So what's that multiple from that case?
It used to be like 15% compound monthly growth rate would get it done. That's still true in some parts of the market. If your application layer AI, it's probably more like 25% monthly growth rate plus right now, but it's hairy. I mean, on the flip side, if you're in a deeper tech, let's say building AI with more deterministic type models in industries that aren't as easy to just LLM problems away because you're trying to predict things other than the most likely next words. There's more technical defensibility and technical moat there. But I mean, the sad reality is I'm a geriatric millennial, so I use this term with familiarity and love. But like pre-2022 at the most recent, any startup that raised before then is kind of a geriatric startup at this point. And I think the math is even showing that pre-2024 means you're a geriatric startup now. So the bar gets a lot higher. I'll give you one counter example to that. We have a company in our seed portfolio, deep tech AI for electronic engineering for simplicity. Started in 2018. We led a $7 million seed round in 2022. They'd raised like $2 million before that. They just closed a $20 million Series A with like, 2 large enterprise customers because what they do is incredibly deep tech. Their logos that they have are, the most impressive logos you can have in this space. And people are seeing that this is not an LLM problem. This is a deterministic AI problem. So for them, it's just totally different calculus. Like they're geriatric, but they're funded and they're not growing anywhere close to 15% monthly right now, but they're on the trajectory where they close these big logos and they'll blow that out.
Yeah, and I would just say that from our perspective, I think definitely we're seeing the numbers much higher and faster than before, but I think it does vary by subsector. So I think if you think about a VC, if you were sitting in an investor's shoes, one of the things that you do is you look at what's the competitive landscape and who are all the players. And typically we've met with a number of the players in the space until we find, okay, we really have conviction with this founder and this team. So you have some reference points of how the growth rate is in that space. And so we're looking to see how you compare with that space. So I think it's not always easy to find, but it is, you are able to look at references in the specific sector that you're in or subsector, and how are the other companies performing and what their growth rate's like, and how do you compare?
We'll go here and then you in the back.
So earlier we talked about like early stage fundraising format was convertible stake, right? We talked about we should give out like MFS, or we should give out like real puts. Those kind of things, but for you, reality, we sit down with VC, especially top tier VC come down. They come with a term sheet with you. Basically we don't have much negotiate power as part. I would see like your suggestion from their side table. How do you want us to negotiate deals to get better deals for us?
Yeah, and if you have to take that MFN or pro rata, you got to take it, right? Like that's, I mean, just to be clear, like this is one of those situations where if you really want that money or you really want them on your cap table, you have to do it. And our founders will make the exception. My advice is just not to give it away to everybody, right? Like that's the more common mistake at pre-seed or seed. It's just like, I like this guy. You're like, well, you like all 16 of them, and there are 22 people on your cap table now. And so, I think that's more of the issue. But if you had like a top tier VC that was very specific to your vertical and stage, that you're like, I need to have this VC on my cap table because its optics at A are going to look fantastic, I think you have to do it. Like, in this economy, you can't leave money on the table.
Yeah, I agree. I mean, you have to make your choices. I think if you have choices, then you should analyze and be very thoughtful about it. If you don't, then you take the money. But think about how you want to, what are the steps that this is the whole two-step process type of thing. What have you learned from that first round? And for the next two rounds, what are the steps that you take today over the next 12 months that get you in a better position for that?
Awesome. Thank you. Yes, in the back.
Yeah, question.
So
running a seed round, we found it was really advantageous to just say, hey, it's like a banking city deal, 2 weeks. Here's the thing. Let the process spike. Is the same thing in the Series A, or is it a longer process, or how you guys like to be?
I think this is one of those things where I was mentioning. Sorry, can you guys hear me in the back? Oh, the question. They were asking how long is it a type fundraising process in Series A, 2 weeks, or what's the timeline? What's the process? I think one of the things to keep in mind is the point that I made earlier, which is you're constantly raising as a founder. So what I mean by that is a year before, you hopefully have met a lot of the investors that you're going to be raising the round from when you're ready to raise that. So at that point, you have a better sense of what is it that they look for? What's the target? What's the revenue track or growth rate? What are all the metrics and efficiency, et cetera? And if you meet those, you can close that round quicker. Sometimes it can be as quickly as 2-3 weeks. We've participated in rounds like that, but we knew the founder, we know the investors. There's some known quantity there that enables us to move quicker. In other cases, we've known the founder for a year and we've been watching the progress, and when they're ready to raise, we close that quickly. But there are other founders that might take 3 to 6 months to raise a Series A.
I'll say if you want to close it in 1 month, then you should have met Anish 6 to 9 months ago and be sending him your quarterly or monthly milestone updates. I've had clients close a significant price round in a month. And how they do it is they line up all their VCs like horses at the trace rack. They solicit like 3 term sheets. They run it past legal and they're like, this good, that good, this good. And ultimately we say, yes, no, yes, this is the best one. And then they choose, right? But a lot of times they choose also because they just like the guy or the girl who's like running the show at that VC, right? Like they have a relationship there. There is something to be said about building that relationship for 6 to 9 months, because even if that term sheet is not the best one, it's kind of an easy decision at that point.
Yeah, and I'll bring sort of the more co-investor perspective here. It comes down to having that lead investor locked in place, right? And this element of having known each other for an extended period of time helps tremendously in making the case to an IC as to why this round needs to be so sort of compact, especially for the smaller co-investors that have more sort of focused teams that are working on 10 different deals. There needs to be a solid case for why it should be all hands on deck for just one, right? And if you can build that relationship 6 months ahead of time, that definitely helps make the case to the entire team and not just the stakeholder you're trying to write the check.
I would just be careful if you haven't done these things. So if you don't have all these investor relationships built and you've been keeping them updated and you're, kind of crushing it and on that trajectory for Series A, then setting this artificial I'm raising in 2 weeks will really work against you.
Awesome. I will go back. Oh, you're okay? Great. We got that question answered. I'll take one more question and then I'll close on a question. Then we'll have some time for folks to mingle, come ask, more personal questions that you might have. Yes, sir.
Friends who were VC of here. It was pretty early on, but I was asking him, a few people to make some introductions to VCs up here. He was basically like, even if you had something ready to show them, there's probably a chance I couldn't keep competing with these VCs. So it's kind of like, okay, how would you guys recommend starting to build these relationships? Obviously, things like this are great, but
I think, that's a great question, especially if you're a first-time founder and then you're getting into this ecosystem, it might seem overwhelming. And I think it's good to do homework, attend a lot of these events, get to know people. I think the other thing is, as you're developing your idea, just put yourself, play role modeling, right? Understanding, like, if you were in the shoes of these investors, what do they go through? So a typical investment firm probably sees over 1,000 companies a year easily. Sometimes they're doing it at demo days and there's a bunch of pitch events. Sometimes they're doing meetings daily with entrepreneurs. And they only write like maybe 10 checks a year. So that means they say 990 no's. And they don't have time necessarily to meet with every single person that wants to meet with them. So just put yourself in those shoes and say, okay, what's going to get me up there? And I think it's a lot around developing the idea. I say prioritize customer while you're developing these relationships and really understand the solution that you're building and how you're making this really something that's going to be valuable with substance that you can put forward. And that makes the conversations with these investors a little bit easier and faster.
I would add that my most successful clients actually don't go through other VCs. They go through high-performing founders on that VC's docket. And I think in this industry, and I'm, from the Bay Area, just like Anish, like there's a lot of introductions that are made, and we have tons of clients who are like, hey, can I get an introduction to Anish? And that is great. But here's what, like, if you're asking your lawyer, your CPA, your service provider for an introduction to a VC, and you're not asking like a founder, it's just not taken as seriously. I say this as a lawyer who knows some stuff, but like, it's much more credible to come from a high performing founder on that guy's docket than it is to come from people like me. And that's just because essentially it's kind of a self-serving ask if I ask Anish to fund my clients that he can pay my bills. And in some ways there's a little bit of a conflict there, right? So I think the best are founder to founder introductions. And those are the clients that really, really actually are much more successful than the warm emails that I might make to Anish.
Yeah, I'm still a big fan of cold outreach, LinkedIn, email. There's a luck component to it in terms of what time you land in the inbox, if people are receptive, heuristics, but I've seen it being done really well recently with how good AI has gotten with it. So I'm still a fan of trying to start that relationship via cold outreach.
Awesome. Thank you. We're going to end on a bit of a speed round, just, open question for the group here. But a lot of founders in the room, first time, second time, third time founders in the room. But if you were to advise on, something that they could be doing in advance of their next investor meeting, and particularly as they ramp up for an A, what's something that you would advise them?
A lot of my clients are really evaluating their business model right now. And I would love to know if a lot of people here are doing this. In light of how AI is coming to play and how we're using it, in theory, if your AI SaaS or PaaS works, then I as a customer don't need to buy like 10 seats. I just got to buy like one seat, right? And so some of our clients are kind of going towards outcome-based pricing, and they're analyzing a switch to that. They're kind of in hybrid stage right now. But I've heard a lot about this in the past quarter about the shift towards outcome-based pricing. And I'd love to know, and maybe this is a conversation for after this panel, where all of you are at pre-seed and seed.
Yeah, I think there's so many things that as a founder you have to do. But I think the number one thing for me is obsession with the customer and how the market is evolving, and just being right there with how things are going to look like in 6 months.
I think numbers and knowing them, pretty cold on what gross margin looks like is gets overlooked a lot of times. I think something that kills momentum, and to Nick's point, this is a momentum business, is when a founder says, let me get back to you on ARR, right? Obsession with the customer, obsession with the business should mean obsession with where your numbers are right now. And that's just a weird heuristic or signal when I just don't get it straight up. And so having the numbers out there, as accurate as possible really just helps make the case and build a story.
I would just say get started, especially if you're a first-time founder. You're never going to be perfect. And what you do now will probably change in 2 weeks and in 4 weeks and in 8 weeks. But if you don't, I see a lot of first-time founders and even seed to Series A founders who are like, well, I just need this to happen. And then it happens. And they're like, well, I want this to happen. And next thing you know, 2 years have gone by between rounds and nobody cares about you anymore. Just get started, share updates, tell VCs like to know how you think and how you act, especially on the seed to A journey. So you can figure out like, where'd you get stuff wrong? What are you unsure about? What are your strengths and weaknesses? Nobody expects like Superman or Superwoman in that seat. We want to make us be creative and think about, because, we all overvalue ourselves so much. Like, we want to think about how we can be helpful and where can we help this company. So just get started, and it's not going to be perfect, and it never will be, but it's okay to be sloppy. Just know enough about like where the big potholes are with VCs to not step in those.
Awesome. Thank you. Well, I would just like to give a huge thank you to our panelists for coming up today and chatting through. And a huge thank you to everyone for taking some time out of their day to come join us on the first day of New York Tech Week. Show of hands, whose first event for the week is this one? Nice. It pays to go early. You get the turnout. Super excited that you're all here. We're going to keep the room open for the next hour. Feel free to mingle. I'm sure there's some food and drink in the back. Our panelists will be around in the room, and there's tons of other folks in the room that you can meet. So I hope everyone leaves here with two things. That is some great insights from the conversation and a new friend. So happy New York Tech Week. Thank you, everyone. Signing off.